Hi! Have you ever come across the terms open-end and closed-end funds and wonder what the differences between them are? Today, we will be bringing you through a quick introduction of these two types of funds and the costs and benefits of investing in each of them. Now think of a car going down a highway. It takes in passengers before it leaves and lets passengers out when it reaches its destination. But it doesn't make sense for passengers to board or alight in the middle of the highway. Similarly, a closed-end fund raises capital from investors at the beginning of its fund life. Once this subscription period is over, the fund is closed. This means that new capital cannot enter the fund and existing capital cannot exit the fund. Most private equity funds and venture capital funds are examples of closed-end funds. Now, instead of a car, think of a train. Passengers are not limited to the first and last stops on the line. There are regular predetermined stations throughout where they can board or alight. Similarly, open-end funds allow for ongoing subscriptions and redemptions. This allows capital to flow more freely in and out of the fund, and not just at the start and at the end of the fund's life. Often, the fund does not have a predetermined lifespan and will continue indefinitely. Most mutual funds and hedge funds are examples of open-end funds. The main benefit of investing in open-end funds is clear. It allows investors to enjoy regular liquidity. Additionally, instead of selling shares on a secondary marketplace where the market price fluctuates with supply and demand, the investor can now redeem shares directly from the fund at a net asset value, with certainty in how much money they will be getting back. Now, at face value, open-end funds are all upside. But closed-end funds restrictions exist for a reason. They mean that closed-end funds can generally invest in less liquid securities and do not have to keep cash on hand to meet redemptions. This greater flexibility allows the fund managers to manage their portfolios more efficiently. The hidden cost of open-end funds is that investors miss out on these potential gains. Now, to illustrate, let's look at a typical venture capital fund. Venture capital funds invest in early-stage companies, which has the potential for high returns. But several years will be required to realize these gains. Until then, venture capital funds often post negative returns. If the fund was forced to exit investments to meet redemptions during this investment period, they would not be able to carry out their investment strategy and realize these gains in the longer term. Well, ultimately, which is more suitable for an investor really depends on their own investment objectives, risk appetite, and investment time horizon. At ADDX, we are committed to help you understand and access the private markets. Do keep a lookout for more upcoming educational content and feel free to reach out to us anytime. Thank you for watching, and I'll see you again soon.